G'day, Internet. Max right here, and super happy to have my good friend back from Valshar Capital. Jeff, how you doing, buddy?
I'm doing great, Max. How you doing?
I'm doing really well, thanks. So it's been a few months since we've chatted. There's been all the things that are happening. I believe for a period there you became a perma bull. You went from perma bear to perma bull. Of course, that's just what people are calling you. You always just read the markets. But you went bull there for a little while. I think the bull icon's missing out of your Twitter handle, so I'm not sure if you're still bull. Tell me, let's give us a catch up. We've got all the banking things to talk about. So much fun stuff to catch up on. Why don't you just go from the top with whatever you think's the most interesting, and then I'll jump in with some questions as I see fit.
Sure, that sounds good. Well, the problem with me is I think so many things are interesting, and so I'll just start throwing some stuff out there, and then we can talk about whatever we want to talk about. So, things that I follow that I think are very important. What is liquidity doing? That's one of the things I check out. I consider what is global liquidity doing and what is the net liquidity in the United States doing. What are interest rates doing? How are they responding? What is the Federal Reserve doing? You know, we obviously just had this meeting with Powell yesterday. So that's interesting. We can talk about that. I'll start by saying I think we've reached the top of the federal funds rate hike cycle. I think the markets are probably sensing that today, even though they responded negatively yesterday afternoon after the press conference, which may or may not have been related to Powell. I think it had more to do with what Janet Yellen said, basically that they may not be backstopping bank deposits. But that's neither here nor there. Who knows why the market moves like it does. But and then the way I view things from kind of an overall, the 30,000 foot view, I think the best analogy is sort of like the hurricane model, right? And so you have your first wave that comes through of destruction in the bear market, and then we have the eye of the storm, and then you have the second wave. I think that as of yesterday, we're probably in the eye of the storm, and you could argue that the eye of the storm actually started way back in the beginning of October. That has more to do with liquidity than anything. I think it kind of culminated at that period, that first bear market culminated with what happened with the UK gilt, the pension crisis and everything. And that sort of caused the central banks to change their policy at that point they were so aggressively hawkish up until then. And then everything sort of stabilized from there. Liquidity has been sort of slowly rising since then. And then we've been seeing kind of a nice rebound in risk assets. Obviously, stocks have been doing well here in the U.S. Emerging markets, gold has changed course. Bonds, for their part, the dollar broke down from its highs of like almost 115, and it's still in a clear bear market at 102 today. And Bitcoin, which I call the great absorber of liquidity, is up from its lows of under 16,000. It's sitting at 28.5 as we speak. So lots of things to talk about there. And then if we're in the eye of the storm, that implies the next part of the storm is coming at some point. I still think we have another storm ahead of us.
Nice. Let's I want to zero in on the liquidity word because it's a word that I'm still trying to get my head around and understand well. You've had some really interesting posts on it. You've been educating me a lot on Twitter. Can you go a little bit more into detail? What does it mean by liquidity? How do you measure it? And if you're able to show me graphs or anything, that would be amazing.
Sure. So a couple things. So first of all, I see a lot of confusion on Twitter about this and what liquidity is, and I see people who it's getting more popular, right? More people are talking about it, and so I think people are kind of misusing the term. And I think there's two different parts to it. So there's the M2 money supply. That's the broad base of monetary supply. That's basically everything that Americans have in their checking, their banking accounts, and money markets, those kind of funds. How big is that? That's sort of the M2 or the broad money supply. That's different from liquidity when I use the term liquidity, but more properly means what is the amount of cash and credit available on institutional balance sheets. So it's more like the wholesale money market, and that's different than liquidity than the monetary base, the M2 monetary base. So liquidity, basically what happens is when liquidity is increasing, and this stuff involves quantitative easing and quantitative tightening, right? The things that the Fed does, the current bank term funding program, those kind of things, those involve increasing or decreasing liquidity. The money supply for itself has more to do with the people's money. And so how does that increase? When banks lend out, when usually smaller regional banks make loans to people and small businesses, that increases the money supply. Also, when the Treasury, like they did post-COVID, they just injected money into the bank accounts, right? They just did basically a deposit directly into your bank account, and to lots of Americans. That also increases significantly the M2 money supply. The M2 supply, I believe, more affects price inflation, so CPI metrics, along with supply and demand, those kind of things, basic econ 101. That's price inflation. Liquidity, so institutional money. When Goldman Sachs has $1 billion of liquidity of cash reserves, they're not going out and buying groceries with that money, right? They're putting that into assets. So that affects the prices of bonds, stocks, private equity, even Bitcoin, real estate as well. So those are the two. That's the distinction. And then if you want me to go,
could I ask a follow-up question? So you taught us how the M2 money supply expands. How does the liquidity expand?
So that's the Fed's role now. So when the central bank is doing the things, when they're doing quantitative easing, what they're doing is they're basically creating money on their balance. They're creating bank reserves, literally creating dollars that goes into the banking system, and in return they're buying treasuries and things like that and putting treasuries and mortgage-backed securities on their balance sheet. That's how they add liquidity into the banking system. They can literally just do that out of thin air. Even what they just did recently with again the bank term funding program, they just created this sort of money, and then they allowed banks to come to banks that were struggling, say, hey, we know you have terrible collateral, you have a interest rate mismatch, a duration mismatch, you have all these long dated bonds which have lost lots of value. Tell you what, we will take your collateral, we will consider that as legit collateral, and we will consider it as collateral from your cost basis, not from the price that it has fallen to. We're going to say, even though it's fallen to maybe 60 cents on the dollar, we're going to say it's worth the dollar that you bought it for, and we'll give you that amount of money you can borrow from us. And so they're doing that, and that's so they're taking the risk of those bad, I would say, duration mismatch purchases that a lot of these banks made. They're taking that risk upon their own balance sheet. So they're adding liquidity into the system. They're stabilizing the system.
Very good. So I'm going to say something back to you. Let me know if I'm on the right track here. When people kind of learn about how money is created and things like that, generally we learn that there's a certain amount of money created at the Fed and whatever that seeps out into the banking industry, and then the commercial banks do the vast majority of money creation by the issuing of loans. And it sounds like you've described those two concepts there. And does that match pretty well to what you've said?
Yeah, partially. And I would say more of the loans, though, like in the US, are actually created by these smaller regional banks, small businesses, like small business loans. Those actually create the majority of the loans that are out in the system. What bigger banks often do in investment banks, they just invest that. So what is BlackRock and Blackstone and these huge players do? They go out and put $1 trillion worth of real estate bets on, right? And they buy real estate and create REITs and do things out of that. That's how they invest those reserves and make extra money on it. And the huge downside of that is that jacks prices up. So if you're like a real estate investor, that's good. However, if you're a poor person who's trying to buy your first house, that's not good, right? Because now the prices have jacked up. They've doubled in 10 years or so, and you can't even afford to buy a house.
Okay, so now M2 money supply, I think that's pretty easily tracked on the Federal Reserve website. Mm-hmm. Is there a relatively easy way to track this liquidity metric you're talking about?
It's a little bit harder. Well, there's two different kinds of liquidity. So we can talk about worldwide liquidity, and we can talk about U.S. liquidity. And it had been previously thought of, what is liquidity? It is just the central bank's balance sheet, basically. What assets are they holding currently on their balance sheet? Normally long-dated treasuries and normally mortgage-backed securities are what's on there. And you can go and look at what that is actively. You can go to the FRED site, right? The St. Louis FRED. It's fred.stlouisfed.org. Yep. And if you go there, they have all of this data readily available. And the one that I look at to see what is on basically what is the reserve bank credit, this is updated weekly. You can look at that, and right now that's sitting at $8.4 trillion for the Fed, and that is up, by the way. On Wednesday, March 8th, it was 8.3 trillion. It had been declining from a high of around 9 trillion back in May of 2022 and March of 2022. It was just under 9 trillion, had fallen all the way down because of quantitative tightening down to 8.3 trillion. And then just recently, because of this stuff that happened with the banking panic, it spiked from 8.3 to 8.44 trillion. So basically $140 billion were just added back onto the balance sheet of the Federal Reserve. Talking about net liquidity, that's just part one. So there's two more parts. You also have to subtract the Treasury general account balance and what that's doing. The Treasury general account, the way to think about that. So Janet Yellen, the head of the Treasury, they take tax receipts in and then they pay out, tax like rebates to people, things like that. There's other ways they get money. They used to get money from the Fed as well. That's just kind of another story. But so basically the way to think about that is if the Treasury general account, which is kind of like the checking account for the US Treasury, if that's increasing, that means more money is staying in the government coffers and less money is in the private sector, right? And so if that money is going down, the Treasury general account is headed down, that means more money is headed into the private sector, and therefore that usually pushes up asset prices. So that's generally bullish. That's considered a liquidity expansion. And then part 3 is you have to subtract what the overnight reverse repo market is doing. And so what's that? So basically when companies, when banks have a lot of excess leverage, they can put that, their bank reserves, they can put those reserves, that cash, into the overnight reverse repo market and earn a rate on that, which is considered to be the safest of safe rates, right? It's backed by the central bank, the Federal Reserve. And right now, those rates are comparable to basically what is the federal funds rate. So right around 5%. So totally, completely risk-free. They can park money there, and that's out of the basically the investable portion of their assets. They're just parking it for pure safety reasons and earning a 5% yield on that.
Got it.
Or so.
Okay. So I have 2 questions, probably best done in reverse order, unless the answer to the first part is really, really quick and simple. You've explained an equation there about how you arrive at liquidity. Is there a nice, easy chart that the average person can pull up on like TradingView or something to show this? That would be question 1. And then question 2 would be, why the hell are we talking about this? I probably should have asked this first. Is there a high correlation between this and asset prices?
Yeah, so let's start with that. So yes, right. Otherwise, we wouldn't be talking about this. There's an unbelievably tight correlation. Now, that doesn't mean it's causation, but it's hard to disagree with it when you look at it. And I would say I like to believe that America is a free market economy. It is not. It is a centrally manipulated economy, right? I mean, that's why we all care about what Powell says. That's we're all blathering about the federal funds rate, all this kind of stuff. It is a centrally manipulated economy for sure. Okay, and so when you go back and you look, you can see how it tracks basically from the COVID crisis right after. So the markets collapsed. The Fed rushed in and added liquidity. Right, they did quantitative easing. They bought treasuries and mortgage-backed securities. They're adding liquidity into the system to stabilize the bond market and increase liquidity in general to help smooth the functioning between banks. And then as they did that, there's literally almost a 1-to-1 correlation of the S&P 500 and or the NASDAQ. As liquidity increased, the Fed's balance sheets increased, so too does the stock market, basically. That stuff all peaked basically the end of Q4 2021, Q1 2022. All of that peaked and started heading down. Net liquidity actually peaked a little bit before that, almost perfectly correlating with the NASDAQ and with the S&P 500. Has been coming down all the way until October. That's why I like to use. So the end of September, beginning of October, that bottomed. And then here in the US, it kind of went up into the end of January, fell through the end of February and into March, and then just recently spiked because of what happened with this bank crisis. Why does any of that matter? If you think about what the stock market did, it did exactly that. It fell all throughout 2022 into about basically October, where it bottomed. And Bitcoin also, I call Bitcoin the great absorber of liquidity. It tried to bottom there, but then we had the whole scam bankman fraud ordeal that sucked it down a little bit further into the beginning of November, but then it made up for lost time. So since then, it's been really obviously doing quite well. Liquidity expanded again. The stock market's expanded. Stock markets have all increased significantly. Bitcoin especially has increased significantly. Peaked about February 2nd. All of these risk assets peaked, which ironically was about a week after net liquidity peaked. Net liquidity started heading down. A week later, stocks and Bitcoin peaked. They started coming down again until just recently, and then all that spiking again. So that was hopefully that makes sense. That's why we talk about this. I think what people really need to understand is liquidity, especially net liquidity. And when we think of liquidity in the hands of institutional investors, huge investors, right? Investors that are able to make billion-dollar investments and such, that's what moves the markets. When you or I, Max, buy our little allocation of the S&P 500 or Bitcoin or whatever it is we're buying, it doesn't matter. It doesn't move the market even slightly. But when these guys are buying or selling, that definitely moves the markets. And so that's why liquidity matters.
This is the chart that Jeff was just talking about. You've got the light colored line, which is the liquidity.
That's perfect.
You see that one? The light colored line is the liquidity, and the dark line is the S&P 500. You see, here's the COVID crash. The Fed responds, and then you have this very, very tight correlation. As the liquidity increases, market goes up. And a slight leading indicator, by in terms of months here, a slight leading indicator that the liquidity drops, the market peaks a month or two after, and we start heading down. And this only goes to, I guess, 2022, as we're not hitting 2023 yet. So we're not seeing the last little parts where the banking crisis kind of broke this correlation a little bit. Oh, sorry. Sorry, you want to talk?
I was going to say, and you can see on the upper left of that chart that talks about what we're talking about, right? Fed net liquidity equals the Fed asset, so that's the on their balance sheet, minus the Treasury general account, plus what's in the reverse repo market.
Gotcha.
So, yep.
Excellent. I'll stop that share right now. Go for it.
So you can look on that Fed St. Louis site and go to each of those three things, and then you can calculate it out by hand. That gets pretty cumbersome. I used to post that, and I used to actually do that by hand. I literally was on a little back of the envelope and calculating this stuff out. It's much better, though, to see what is the larger trend doing. I have those same factors that you just showed on a TradingView program. It's all kind of in code word.
So, okay, we took a little break here, and Jeff walked me through some of the tech here. So I'll put this in the description. But if you go into TradingView, you can just copy and paste this text right into your ticker search, and you end up with this. And Jeff, what we're looking at are those three things. It's this is that equation that you talked about, correct?
It is. So that's the code for basically that first one, WALCL. That's the Fed's balance sheet, and then minus the holdings of the Treasury general account, minus the reverse repo market.
Gotcha. And that gives us this chart here, the blue line.
Yep.
And so this is, now correct me if I'm wrong, this is U.S. liquidity.
Correct. United States only, we're talking about.
United States only liquidity, and we get this chart here, and you can see this, here's the banking crisis here, and this massive injection of liquidity. Okay, and this is measuring, I'm guessing, no, this isn't an actual hard figure. Okay. So that's interesting. Liquidity significantly shrunk in the last couple of days, but okay. And so now, so the significance of this, as we just covered earlier, is this has been a really, really, really good picture, especially for the S&P 500, of predicting exactly what's going to happen there by a month or two. So a really, really good leading indicator. Now, where would you think is the best place to take this conversation next, Jeff? I am kind of curious in the worldwide aspect of this. So the difference between U.S. liquidity and worldwide liquidity, does one or the other map to what would we say, different assets better than others?
Yeah. So a great way to think about that, at least, and again, correlation is not causation, right? You have to factor that in. It may just be a coincidence that all of this happens to kind of mirror almost one-to-one. I don't think it is, but you have to do your own research with this kind of stuff. Worldwide liquidity, as it increases or contracts, I think it makes sense, right? It affects worldwide assets. So what are worldwide assets that we can think about? Commodities in general. Bitcoin, I think, is a great worldwide asset. You can look at different markets. So there's times, and we've had times recently, where China has really been adding liquidity while the US has kind of been flat. Chinese stocks can tend to outperform. Japanese has been adding, liquidity as well, significantly. They've been doing that for a long time. That can cause those separate markets, especially their equity markets, to outperform. So if you see a government sort of behind the scenes adding tons of liquidity to their system, you make a pretty safe bet, I would say, or it's a higher probability bet that their stock market will outperform in that time period as well. So that's what I look for. I don't have great measurements. I don't have a little secret code I can give you for worldwide liquidity. I follow a guy on Twitter who goes under the handle Cross Border Capital. His name is Michael Howell, and he's from London. Brilliant man. They do a ton of high level research looking at global liquidity. What I like about him is he just randomly will tweet out every once in a while their charts talking about it. And to his point, global liquidity absolutely bottomed basically in October of 2022 and has since been increasing. That's why I think we've been seeing such a nice move in Bitcoin. And then as the U.S. has followed suit, we see the U.S. assets do well too. I think emerging markets, because they're kind of basically, very China focused, China heavy, Asia heavy, the easing that they're doing, the liquidity additions that they're doing, just bode well for their equity markets. And we've been seeing that over the past several months.
Okay, this seems like a pretty powerful cheat code, but again, guys, do your research, do your due diligence, and play with this and check it out and see what you're looking at there. So, okay, so let's go for you mentioned the concept of we've had a leg down, we're in the eye of the storm, and there's a second storm to come. I'm given this, and given what you said your belief is about these particular charts. What I'm hearing from you is that you believe there's going to be a second round of a decrease in liquidity. Is there a narrative or a story behind that you think is coming?
So this is where things get even more interesting. First of all, I know people are going to quibble with the fact that this addition of liquidity here in the U.S., the increase recently of net liquidity, is not traditional quantitative easing. So I want to make it very clear. I'm not saying that the federal government is undergoing quantitative easing per se, but the market is interpreting it as the financial markets are being backstopped by increased liquidity, and they've been responding in kind. So whether or not that's the intent of the Federal Reserve right now, the markets are responding to it as such. I just want to make that clear, because a lot of people quibble about these kind of things. I just want to make it clear, I'm not saying the Fed has pivoted and now they're doing all-out quantitative easing. Where it gets interesting, a couple of things. First of all, the net liquidity makes me optimistic about what's happening here in the U.S. and around the world. A second thing that makes me optimistic is after Jerome Powell's speech yesterday and the rate hike, I think they're done hiking rates, and I think the markets know officially that they're done hiking the federal funds rate. And if you look at the federal funds futures, the CME futures, they basically say, yes, we've peaked, we're not raising anymore, and starting in July, we're probably going to start lowering rates again. Those are just predictions, obviously. That doesn't mean this is what's going to happen, but I would agree sort of with that mindset that it looks like we're at the top of the rate hike cycle. We're now at what I would say probably is the Fed pause, where we're sitting at 5% federal funds rate. I think we sit here for a while. Historically, when that happens, we get what's called the Fed pause rally. Risk assets, which have kind of gotten beaten down as they've been raising rates, they get sort of a second wind, and they tend to do pretty well. I like to bring up the example of 2006 to 2007, summer to summer. The Fed paused in 2006 and held them at, I think, 5.25%. You can check me on that. But in that time period, that 1 year, actually from the summer to October of 2007, summer 2006, October 2007, NASDAQ stocks went up 53%. That's a pretty impressive rally. And so these eye of the storm rallies, these Fed pause rallies, can be pretty substantial. I think that this is what the markets are currently signaling, is that they're kind of in this sort of tentative risk on mode for now. So again, for now is the key word. Why did I take the bull out of my Twitter handle? It's because I only think this is a for now type approach. It could last for a week. It could go on for several quarters. I don't know how long the eye of the storm will be here with us, where we have this kind of Goldilocks. I hate to use that term because CNBC uses it all the time. Goldilocks period. But then what will happen, even though I think at what we're finally going to see, kind of similar to what happened in 2008, is, we've seen a few banks fail so far. I think that's just the beginning, and we're going to have more of those moments. I think the credit, so couple things. I'm sorry, I have all these different things happening in my head right now. We had massive yield curve inversion. The inversion is starting to decrease, and the curve, I think, is going to start correcting itself and actually be normal in a few months. Basically, what that means is the market believes the Fed is done hiking rates. They try to go back about their normal business. That does not mean, though, the coast is clear. That actually means that we're getting very close to the recession finally happening. And so I think the recession is very close. An official recession. The National Bureau of Economic Research, they're officially going to declare it. I think we'll see unemployment rise. Things will get ugly. And basically what will happen is the credit crunch that's happening right now. Banks can't make money. They're battening down the hatches. They're not making loans right now. People can't get loans. It's hard to, the money supply shrinks because of that, the M2 supply, because loans aren't being made. In fact, people pay off loans if they can. They definitely are not taking out new loans. Small businesses are firing people. They're definitely not taking out new loans to grow and expand their business. It's a batten down the hatches kind of time period. And eventually that overwhelms even this sort of mild the mild liquidity expansion that we're seeing. Eventually, the seriousness of the credit cycle overwhelms this other stuff, and it brings everything down with it. And that's where you get what I call kind of the late 2008, early 2009 moment. If you remember that the markets kind of kept trying to go higher, and then they'd come down and they'd try to go higher. They were basically crabbing sideways. And then all of a sudden the floor just dropped out, and they're like, oh my gosh, this is just really terrible. These huge rate hikes, this yield curve inversion, these banks that are failing, these Fed patches or band-aids that they're putting on the system to try to fix it. Like they just open these, the discount window, they open these other windows basically to send the banks a lifeline. That works for a time period, and it makes people feel good, but eventually the truth and the reality of this horrible credit situation that we're in basically overwhelms everything, and we have a huge floor dropout moment in all risk assets. I still think that's most likely. There are people who disagree with me. Raoul Paul is one. He actually thinks we're through probably the worst of it, and we're going to sail through this now, and it's kind of blue skies ahead. I'm not nearly so optimistic. I think we may have a run, but then the credit cycle will overwhelm, and then that's when, by the way, we convert from this sort of quasi tightening, right? Because the federal funds rate is still high, it's still tight, higher for longer, they keep saying, because of inflation. They're not really doing easing, but they are doing these little patches to help bolster liquidity. At some point, they're going to be like, you know what, the system is falling apart. We need to get serious, and they're going to pivot completely. That's when you have the Fed pivot, and they're going to lower the federal funds rate really quickly to help kind of stabilize the system. And they're going to start just flat out buying long-dated treasuries, buying mortgage-backed securities, maybe buying other stuff, reloading their balance sheet again, massively increasing liquidity again. That's still in the future. They don't do that because life is good. They do that because it's terrible. And they do that because the system is fracturing and everybody's in panic mode. So that's still ahead of us somewhere. I just don't know when it's coming.
Gotcha. Are you in a position where you're like dialing down investments, or are you waiting to see certain things before you do that?
Still holding on, again, because I think we're in that eye of the storm thing. I hate this kind of point, right? I love 2022 just because we just knew things were going down, and it wasn't really much of a question. Now, though, with these sort of equal and opposing forces, it makes things difficult. I think the best way to trade this is actually not as a long-term buy and holder. When I'm talking about equities right now and commodities, I would trade these basically. So use lows to add to a position, highs take profits, lows, and I think we're just going to get this sideways crab action for lots of prices until this gets resolved. Crab basically until a floor dropout kind of moment. I don't know how long that lasts. I imagine when the Fed comes in, they're going to come in with the next level of quantitative easing is going to be an absolute bazooka, and the markets they've been trained to respond in kind, and so I think that will be the bottom for markets, and then we have the next wave higher.
Okay, a pretty clear game plan there for everyone listening. So that's really, really cool. You mentioned Raoul Pal having a little bit of a different opinion there. Is there anybody else that you're aware of that maybe has an even worse opinion? That is to say, no, you're thinking this is what you're saying is sunshine compared to what's really going to happen.
Oh yeah, sure. I'm sort of in the middle right now. I can see the bullish and bearish case, and so I think we get this sort of waffling. There are people who, in fact, most of the rooms I was in, Mike Green, George Noble, I don't know if you know these guys, but they're macro thinkers. George Gammon, I was just in a macro room yesterday with them. They're very, 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 very bearish. And in fact, anybody who brought up anything optimistic, they just roundly just hammered them down. It's terrible. It's terrible. It's terrible. And I'm like, they may be right. All of those guys are far smarter than I am. I would concede to them, but I also know that they've been bearish for several months now, and the market has gone against them for several months. They hate Bitcoin. It's terrible. The NASDAQ stocks are in this huge bubble. It's terrible. So they've gotten their faces ripped off, at least over the last 4 or 5 months. And so who knows? Who knows who's right? We'll find out later.
For the non-trader, you've given advice for a trader to make money out of this. For a long-term investor to ride this storm and come out the other end reasonably well, what kind of an asset class allocation do you think is appropriate to ride this out so you're not sweating every night?
Yeah, so the very easiest way during these tumultuous times is just hold cash. Increase your cash position to 50% or 100% or whatever. You can just avoid all of this if you want. You may miss this eye of the storm, this Fed pause rally for a season, but you'll also miss the crash that I think might be coming after that. And it's hard to know when to get back in. But if you just want it, you just can't take it, sit in cash. Another, I would say the next step, a little bit more sophisticated, buy short-dated U.S. Treasuries. So these, the 2-year yield today is still sitting up at 3.87%. 6-month Treasuries, you can buy those. You can go to the Treasury, U.S. Treasury Direct, I think it's .gov, and buy these things. A 6-month Treasury currently, so 6 months, the annual yield is 4.8%. That's better than I would say most people are getting in their bank accounts. A lot of money market funds, which invest in these kind of things, have really nice yields right now, like 4% or so. Super easy, super safe. You're not beating inflation, but you're also not losing money, and you're seeing little gains in your account because of the interest increases. The next way to do it, I would say, for the traders among us is just to, we're talking about investors. So for investors, the next way to do it is just dollar cost average through this, right? So even if we have a little bit of up and then maybe a sharper down, then we bottom somewhere and then we're up. This is a great time. It was like what I started telling people about 6 to 9 months ago for Bitcoin is start dollar cost averaging. It's a fantastic time because we're getting very close to the bottom. I think the bottom is in for Bitcoin. I don't know that it is for equities. And so I would just say dollar cost average, expect that they may go down for a time, but we're getting closer to that bottom. And then when we come through there, I think we start the next bull market and you'll be glad you dollar cost average through it.
So let me just double check what you said there. You think even after the second leg of the storm, you still think we're not going to go below 15,000 for Bitcoin? Is that what you said?
That would be my guess. Yes.
Okay.
I think the Bitcoin lows are in.
Okay.
Only because this crisis is centered on banking institutions, financial institutions, and it's literally what Bitcoin was made for. And so just the fact that we see banks fail and Bitcoin rise, I think is just because people are starting to understand a little bit the safety factor of being your own bank, right? If my deposits aren't safe, even in my conservative banking account, where can I go? And I'm in enough Bitcoin rooms during the day to know that lots of people are asking this question. I just know lots of people who have decided to move a good chunk of their cash savings into Bitcoin, put it into cold storage, and then they don't even have to worry at all about all this stuff that's going on.
So if there was, for the investor type that we're talking about, a largish cash position, if they were to hold a second, more speculative asset to roll through this, would Bitcoin be your advice?
Yeah, I can't give individual advice, right? So this is just general. Please do your own research. But yes, this is a fantastic time, I think, to be just simply dollar cost averaging into Bitcoin if you want to. Will it go lower if the floor drops out into risk assets? For sure. But do I think it goes back to its lows like sub 16,000? Probably not. Maybe it will. I don't like making those kind of bets. It could be pretty ugly for a little bit. And if it did, though, I would see that as a massive buying opportunity personally, especially because at that point, I would expect the central banks to be just flooding the system with liquidity. And so as that's ramping up and the stocks are going down, we know that this liquidity boost is a leading indicator. So if this is happening, that's a great sign, a contrarian signal that this is the time to be buying that fear panic mark bottom. And again, Bitcoin having such high beta is a great thing to own, I think, at that point. Tech stocks, I think, should rebound well. Small cap stocks, I think, should rebound well. And at the other side, by the way, we should be finally at the bottom of the business cycle and starting a new business cycle. That's usually really healthy for stocks. That's a great time to own stocks, especially things like small cap stocks. Small cap stocks get really beaten down in this phase, and then they're one of the first to recover too. So small cap stocks, tech stocks, Bitcoin, those would be kind of my top three. Gold, by the way, should continue to do well, as for a lot of the same reasons that Bitcoin does well.
So that point that you're talking about, the risk stocks, the small cap stocks, you're talking in the ballpark of 2 to 3 years away. Is that right?
Not necessarily. It depends how fast this happens, and it could take that long because there are a lot of similarities to 2000 to 2003, where this sort of stretched on for 2 to 3 years. It's possible it takes that long, but and then in the 2006 to the early 2009, another kind of 2 to 3 year cycle. The only reason I think this may happen a little faster is because the Fed is moving so fast. They hiked so quickly this rate hike cycle, and I think this Fed pause rally is actually going to be shorter lived. Like the last one, the big one was 2006 to 2007 for about a year. I think that gets shortened up as well because I think we're going to see we're already seeing cracks in the credit system, the financial system. So I think that leads to this floor dropout moment a little bit sooner. And then I think that's going to happen really fast too. And also because, Powell is almost kind of cocky. And when people ask him about this recession and hard landing, he's like, even if we do cause a hard landing recession, we have powerful tools. And basically what he's saying is we are just going to absolutely flood, the economy with just crazy, crazy amounts of liquidity. And you know what? Risk assets respond really well to that. And so that's what I think. And I think all of this will happen a little bit sooner. Probably, I'm guessing it's actually all during this year, 2023, that we get a bottom. We start a new business cycle. We have new quantitative easing, and we're kind of off to the races again. That's just my guess.
Okay. Let me changing topics for a little bit because we've only got a couple more minutes before I know you have to run. I want to ask you about a concept here, inflation. Do you think we're going to have basically, if you're zooming out, so not month to month, not even maybe even year to year, but for the rest of the decade, is it going to be a high inflation regime?
Definitely higher than last decade. I think we're going to have more inflation volatility. I think it's generally going to be, if I had to guess, I'd say we're going to have an average of about 4 or 5% inflation, and we're going to get up to the high levels we saw. We're going to go below. If we have a floor dropout moment in the markets, that's very deflationary. Everything just plummets, including oil, including commodities, all these kind of things. That sucks inflation down. The housing market, everything gets sucked down. We can actually have deflation, meaning negative year-over-year inflation growth. Most people would welcome that actually from a price standpoint, right? If the cost of goods actually went down a little bit, usually what they do though is they just kind of go down to this new baseline, and the baseline is now higher. It was a baseline here, it jacks up, and now it's here, and now it flattens out right there. I kind of think that's what's going to happen. So. But then I think if the markets and everything ramps up again, I do think we have just sort of structural issues, systemic inflationary issues that I think are going to last throughout this decade, to your point. I think, and one of the main ones is peak centralization. I believe that happened, and I believe we're going to bring back manufacturing into the United States, and other economies are also going to become a little more self-sufficient and not reliant on China and Asia to do their manufacturing. That will be inflationary. That will drive prices higher in general, and that's just one of the things.
Gotcha. I'll go just a little deeper on that. I think just in terms of interest on the debt, in terms of massively expanding governments everywhere, I think baked into the cake in everyone's models is that money printers will go burr. That's like a kind of a given. But then the question of inflation and CPI is a little bit deeper because there's another very, very powerful force that a lot of people are talking about, which is the deflationary effects of technology. And Cathie Wood is huge on this and been writing about it for a long time. And I see a lot of merits to those arguments. So I guess you've kind of answered but I'll ask the question more accurately here. Money printer go burr, expect CPI inflation. Technology expect CPI deflation. Do you think generally over the next 10 years, are you expecting those things to generally balance out into a pretty workable lifestyle for the world, or are you expecting one or the other to be dominant?
I tend to lean more towards the less of the deflation camp, and I agree that with the Cathie Woods theory, and Jeff Booth talks about this too, that technology is deflationary. But I think there's a little more powerful forces that are going to be inflationary. War, I think we're going to have more geopolitical strife and more wars. That's extremely inflationary, and I think we're going to have a decade of that. Talking about money printer go burr, again, we have to distinguish between the two. When the Fed's money printer goes burr, reserve assets, they create these assets for these bank reserves. That causes spikes in the prices of the asset classes. So stocks, bonds, real estate, private equity, Bitcoin, increasingly so this decade. Those things go up definitely when the Fed does its quantitative easing. The M2 money supply, so as that goes up, that helps cause higher price inflation. What I think is also very probable this decade, and maybe sooner than most people think, is UBI, Universal Basic Income, I think is a possibility. And I think that's probably how they're going to actually introduce CBDCs to the United States citizens. They're going to be like, hey, who wouldn't want $500 free a month of our new CBDC in your bank account? Just say yes, and I think most people are going to take them up on that. That is very inflationary, right? Because it's now suddenly all Americans, or most Americans, have way more money in their bank accounts against the same amount of goods and services. So because that, it basically increases their demand while keeping supply the same, that jacks prices up. So I think that will be very inflationary. I think that's probably happening this decade as well. And I think those are just going to outweigh the deflationary technology forces that Kathy Woods talks about.
Okay, excellent. Jeff, thank you so much. That was a really, really enjoyable conversation. Really good for it. So it's been like 3 months since I've made a video. I took some time off to be with my newborn and things like that. So it's great to get back into the conversations. Thank you for being one of my very first guests. I greatly appreciate it, and I hope to speak to you again really soon. How can people follow you?
Thanks, Max. It was a lot of fun being here today. I really enjoy our conversations. It's easiest to find me just on Twitter. My handle is @VailshireCap. And then I also, obviously, I'm a fund manager and run an RIA as well, manage money for people. You can find me at vailshire.com, or just send me an email directly at info@vailshire.com.
Okay.